All right, everyone, welcome to Market Newsflow. Today on Tuesday, September 22nd, we're going to run through the market news of the day. To kick things off, let's talk about the muted tone in markets. We see that across the board, especially in the equity markets, with the S&P 500 up a little bit more than 1%, and the Dow performing a little bit weaker, but still up about 50 basis points. These movements are substantial, coming out of a 4-day losing streak. However, again, pretty small. We see Asia up and Europe up as well, pretty much across the board. With regard to Dow futures, just looking up at my screen in front of me, it looks like the Dow futures are up about 20 basis points, with the S&P 500 and NASDAQ futures lagging substantially, down 10 and 60 basis points respectively. It looks like a similar muted tone will continue into tomorrow with the information we have so far. Considering the Iranian sanctions, the U.S. has moved to restore the United Nations sanctions on Iran, so these were things that were originally in place in the 2015 nuclear agreement, and the Trump administration has made efforts to restore these declarations and sanctions. With regard to Trump's presence in the region, we've seen that the U.S. has brokered deals between Israel and Arab states, and more countries are expected to join suit, along with the UAE and Bahrain in the coming weeks. Countries to watch could be Oman and could be Qatar. With regard to Nike, they reported their earnings after the bell today, with China quarterly sales outperforming, rising a whopping 6%. Muted overall sales increase year over year, and the top line was down about 1% year over year. However, the big thing here is revenue was $10.6 billion, as opposed to estimates of about $9.5 billion. This big outperformance led the Nike stock to increase about 8% after hours on the news. In the quarter ending May 31st, Nike posted a net loss and a 38% decline in same-store sales year over year, which is a huge difference and definitely a detriment. With regard to the fiscal stimulus, it is still in question, with National Economic Council Larry Kudlow coming out today to say that no stimulus is needed. However, both Mnuchin and Powell have testified before Congress saying that they do need more stimulus, and specifically in certain sectors. So it'll be interesting to stay tuned to see if lawmakers on both sides of the aisle can come together to make something happen for the sake of the real economy and the American people. So today we're going to do a couple deep dives. The first one I want to talk about is commodities prices. So Chinese pork reserves have run out as prices continue to sour. China has nearly exhausted its reserves of frozen pork, and the supply shortfall in the world's top protein market 2 years after the arrival of the dire African swine fever has had dire effects. The level of reserves is a state secret in China and is kept close to home. However, the world's #1 producer, China, definitely has a big impact on the market as a whole. China's, estimates about Chinese production numbers indicate that they have less than 100,000 tons of pork reserves remaining, and this is compared to about 452,000 tons between September 2019 and August 2019. With regard to spot wholesale prices, they're still more than double their pre-swine flu levels, coming in at about the equivalent of US $7 per kilogram. In addition, this has driven a rally in global feed markets, with soybean futures in Chicago also outperforming, with soybean futures trading above $10 a barrel in the Chicago markets. This is their highest level in years, so this is pretty substantial. This greater reliance on imports when Chinese pork doesn't have the reserves that they used to have means that they're going to be politically exposed to import risk. They need to be able to get that food from somewhere else, which means it needs to come from another country. And given the state of Chinese relations, which we've detailed in previous episodes and talked about just yesterday, there are a lot of issues between China taking over more land in the South China Sea and expanding their naval bases there, and Chinese-American relations, obviously, between TikTok, WeChat, Huawei, ZTE, relations with Germany, relations with India and the Himalayas. There are a lot of things to watch there. So reliance on imports is not necessarily a good thing given the current state of the world. With regard to jet fuel, it is so cheap that it's actually being blended to be used for ships. Not surprisingly, aviation fuel is of a much higher quality because it is straight run kerosene. This is usually the most expensive oil product, but it's now being used for shipping fuel, which is usually substantially cheaper. This is then used to make very low sulfur fuel, and this is good for the maritime industry. But there is a potentially incredibly precarious situation at hand. Using too much straight run kerosene, which is now a lot cheaper and is considered to be like premium quality, however, can lower the temperature at which fuels catch fire, which is a massive issue for vessels. And a lot of people have noted this as a risk. However, jet fuel prices in Singapore are so low that it continues to be used. In September, in January, we saw prices of jet fuel trade above $70 a barrel and then closed at a little bit below $20 a barrel in early May. And obviously, given the heightened demand for air travel in comparison to that time, we've seen a bit of a rebound to $41 a barrel. All right, to move on to a deep dive in commercial mortgage-backed securities, and we'll actually also get to touch on CMBX markets. There are 5 different securities listed on your screen. With regard to CMBS cash spreads, over the last week, we've seen a trend of some tightening. However, in the CMBX market, which is something that we touched on over the weekend, the difference between single name CMBS and CMBX, which is a derivative indice, we've seen CMBS spreads move tighter and then CMBX spreads move wider, which means it's a bigger gap over treasuries or treasuries, because they're quoted on a treasury basis. On your screen on the far left, we see that a Minnesota mall behind the CMBX 7 reported its first time delinquency. This is the $90 million Crossroads Center that is 30 days delinquent. This represents a little bit more than the 7.5% of the CMBX indices. So it makes up a huge portion of the 7th run CMBX. And with regard to New York City diamond sellers, we see that the Diamond District retail condominium loan is now on watch at TREP, which is a big industry newswire that keeps up to date with movements in CMBS markets as well as across the securitization space. The reported revenue and by extension the debt service coverage ratios both fell sharply in the first half of 2020, obviously given the COVID pandemic, and this represents 4% of the collateral in CMBX 8. Considering the office behind the 2015 Wells Fargo issuance, it was sold for $40 million in Raleigh, North Carolina. This is a 210,000 square foot building and backs the $20.5 million Somerset Park loan. This represents 3% of the collateral of its CMBS, which means there are multiple different commercial real estate properties that get pulled together into this security. On the 4th panel, we see the UBS deal, which is the Vistalia Mall, which was extended by a year. This means that because the loan is extended, the value of the collateral has also been lowered, again, given the state of commercial real estate amid the 2020 market pandemic. With 6% of this deal also included in the CMBX transaction, we see a broad scope of this effect. With regard to the last thing on your screen, we see that the JP Morgan deal from 2017 had a top tenant in a Cincinnati office building decide to vacate, which represented 4% of the deal. And these are things that are all on watch at TREP. So for our last deep dive, we want to touch on CMBX. As mentioned, these are the indices that represent derivative positions in CMBS. So CMBS can either be SASBs or be conduits where there are a lot of different commercial real estate loans that get pulled together, like mortgage-backed securities that we spoke to over the weekend. We spoke about residential mortgage-backed securities, both on the agency side and the non-agency side. The idea is you have a lot of mortgages, and for resis on the agency side, you have 2,500, 3,000 mortgages being pulled together in a pool size that'll total about $1 billion. However, in the CMBS markets, we'll have similar things, but obviously, given the size of the loan, there's going to be a lot less loans because the loans are a lot bigger, which should be pretty intuitive. With the CMBX, we see that there's a new CMBX issued every time. About every 18 to 24 months, IHS Markit will release a new CMBX indice. And the biggest ones to look at are 6, 7, and 9 for our purposes right now. Those are the ones that I find to be most interesting. CMBX 6 was the first one to come out post-crisis and has a whopping 40% retail contingency. This is huge, obviously, given the state of retail right now. And in addition, half of its retail exposure is directly to malls. Again, malls are in a lot of trouble right now. There's a lot of question over what the future of mall is going to look like. There are different tiers of malls, and there's an incredible Bloomberg article that actually details how malls are rated, and it's kind of analogous to a credit scale. I'll highly recommend reading it, and I'll actually put it in the description to this video. With regard to CMBX 7, about 2 years later, there was the creation of CMBX 7, which also has a huge proportion of retail loans. 35% retail, and half of those, just about, are in the mall space as well. CMBX 9 is 15% multifamily and 17% lodging, which obviously, given the state of travel during the pandemic, has a lot of exposure. On the right-hand side of your screen, you can see the biggest holdings within this. With regard to CMBX 9, this was the 2015 issuance, and I do want to note that about 23% of the pool is on servicer watch list, which means you have someone in a CMBS transaction that services the loans, so that if something's going wrong, it's their job to come up with a workout or take something that could possibly be non-performing and make that performing. 10% of the collateral is also a little bit, at least 30 days delinquent. So with 10% in the 30 plus delinquency days, that is a huge issue to watch. And comparison to the other CMBX indices, that is substantially higher. Again, just for clarity, when you're playing with CDX, you see that when you are buying protection, you are going short the CMBX, which means that you pay a fixed premium every month. It's very similar to a CDS on single name bonds or different securities, where you have the idea that you are paying for that protection. It is a credit default swap. You are betting against it. It is credit protection. It is like a credit link note. It is like a credit risk transfer. You are short that protection. So when you are selling protection, means you are collecting a premium. It's like insurance. You go long with CMBX. So with that in mind, hopefully that'll give a good interpretation to the current events in the CMBX and CMBS markets. We'll touch on this a bit more in the coming lectures and the hour-long Sunday lectures, so we should get a bit more color there. But awesome. Look forward to seeing you guys on Thursday for session 11 of Market Newsflow. If you have any questions in the meantime, please do shoot me a text or send me an email. Look forward to staying in touch and seeing you then.